Dividends explained. To understand corporate dividends and the investment return that shareholders might realize from having invested in the capital stock of a particular company, one needs to assess it from a legal perspective. In the corporate law context, the principal conceptualization of a dividend is that of a pro rata distribution by a company to its shareholders of a particular class or series of shares of the capital stock of the company, provided the applicable corporate law requirements to pay a dividend have been legally satisfied. The principal constraint on the issuance of a corporate dividend is the financial prerequisite for its payment to shareholders, as seen in Section 510 of the New York Business Corporations Law, which states in part, dividends may be declared or paid and other distributions may be made, either one, out of surplus, so the net assets of the corporation remaining after such a declaration, payment, or distribution shall at least equal the amount of its stated capital, or two, in the case there shall be no such surplus, out of its net profits for the fiscal year in which the dividend is declared, and or the preceding fiscal year. If the capital of the corporation shall have been diminished by depreciation in the value of its property, or by losses or otherwise to an amount less than the aggregate amount of the stated capital represented by the issued and outstanding shares of all classes having a preference upon the distribution of assets, the directors of such corporation shall not declare and pay out of such net profits any dividends upon any shares until the deficiency in the amount of stated capital represented by the issue and outstanding shares of all classes having a preference upon the distribution of assets shall have been repaired. The payment of dividends is not mandatory, with the company's board of directors having discretion to either invest the company's profits back into the company or pay those profits out to the company's shareholders by way of dividends. In the ordinary course of business, a company may generally pay a dividend in one of three forms: in cash, as a dividend in kind by a distribution of company property, if allowed under the relevant corporate law, or as a stock dividend. As for the taxation of dividends, the tax basics have been set forth by Internal Revenue Service in IRS Publication 550, Investment Income and Expenses, with dividends being reported on IRS Form 1099-DIV. Of particular note is that certain amounts received from a corporation that is in fact interest income must not be improperly classified as a dividend, but must be reported in tax as interest income. For more informative corporate and tax videos, subscribe to this channel while look into the IRS's website for greater detail on these and other tax topics. Thank you.